Welcome back, everyone. This week, I want to give a semi-brief overview of how I'm looking at things, how my portfolio is doing, names I'm adding, how they're performing. It'll actually be a shorter video, I suspect. So, with that said, let's go back to around the end of April. I determined that at that point, I was going to try my best to start stacking up cash. And so I did. My goal was that I thought that there would be a pullback in August or September, and I wanted cash for that pullback. And that means that I would be in 50% cash, because if I had all my money up to that point deployed, January through April is 4 months, and then May, June, July, and August would be another 4 months, which means that my portfolio theoretically would be 50% cash and then 50% positions, all else being equal. Of course, that ignores my positions appreciating or depreciating, but roughly in line. So that was a belief of mine. Now, along the way, I purchased, for instance, another share of Tidewater, another share of Valaris, uranium miners, on and on. So I still had roughly, call it 35% cash up until this previous week. And I think I said maybe roughly a month ago that I thought that the pullback would still be August, September. And by the way, there's no facts to this. I mean, I could show you some charts or this or that. I mean, just, a feeling, intuition, nonsensical belief, whatever it is. This is my modeling of the world, and I act accordingly. And that doesn't mean the model's correct. So keep that in mind. Because one could easily just dismiss everything I just said as gibberish. Like, how in the hell are you going to know when a pullback is? And fair enough, I recognize it too, but nonetheless, that was my belief, and I think belief is a good word, because you really can't call that predicated on facts, per se, even though there's information out there. Like I said, you could post hoc rationalize either way. I think there'll be a pullback. I don't think there'll be a pullback. So we'll just presuppose that that's my modeling of the world, and that's my belief system, and that's how I'm operating, which is not necessarily correlated to truth value. Anyway, so I said that I thought that the pullback wouldn't be as severe of a pullback as what I wanted, and that I thought we'd get a 5 or 7%, a 5 or 10% pullback, and I wanted a larger pullback. And my fear was, and still is, that the risk comes, say you get a 5% pullback and the market keeps running up. Well, you didn't deploy any capital into the pullback because you thought there'd be more of a pullback. So two things happen. Either you chase or you sit it out. And the problem with that is here I am trying to outperform, honestly, in the short term. And by short term, I mean month on month. But I'm also trying to outperform on the long term, year to 2 years, 3 years rolling average. And the problem is 35% cash, market pulls back, I don't deploy capital, I'm not going to be able to outperform the market in all probability with only 65% of my portfolio in stocks. And worse yet, every week that goes by, more and more cash builds up. I'll inevitably underperform the market. Now, it'll be beautiful if there's a big pullback, but my modeling is 5 to 10% pullback. Now, I'm kind of in a interesting spot currently, and that's because the market pulled back 4.78%. Now, all these numbers you could very easily argue are arbitrary. So if I'm not supposed to deploy capital until a 5% pullback and then a 4.78% pullback occurs, now just imagine if the market runs up, makes all-time highs or gets back to all-time highs. Well, I never deployed any capital, all because of a 22 basis point discrepancy, 0.22% discrepancy. And I've missed out on multiple trades as a consequence of such small discrepancies. And for instance, I missed out on purchasing the semiconductors last year because I wanted them to fall another 5%. And yet again, you could say that's arbitrary and fair enough. And I missed out on that. So I missed out on, let's call it 100% returns in less than a year as a consequence to bickering over 5%. But that's just is what it is. Anyway, I decided to deploy capital this week. So as you see, the S&P pulled back 4.78%. Now, my fear is this. And this is the 30-year Treasury. You can do a 20-year Treasury as we'll point out in a chart momentarily. This is the 30-year Treasury. And what this shows you is a beautiful looking chart. If the question is, would you buy this chart or would you sell this chart? And to me, it looks like this thing's getting ready to break out. And if it does break out, what that means is that bond yields are going to go up. And as yields go up, as the thought goes, the stock market's not going to necessarily appreciate that. So if yields break out, then it would make enough sense to me for that to put a good deal of pressure on the stock market. And you could look at the TLT, which is the iShares 20-plus year Treasury bond ETF. It's a good enough proxy. And the question is, would you want to buy this? Because I would say either one of two things is happening on this chart. Either this is a double bottom, or it's going to break lower. And I can't say I'm really optimistic on it. So, and I can't say I also am educated and informed enough to have a strong opinion. So, as a consequence of this chart, I should not want to deploy capital. But sometimes you chase. And sometimes you have to participate to not get redeemed. Well, I don't have any LPs because I'm not a hedge fund, so I don't have to worry about that. I'm my only partner. And I'm not limited. I'm the full partner, just me and myself. So, me, myself, and I. So, I went ahead and I deployed capital. So, let's get into that. What did I buy? Well, first of all, let's talk about what happened in the past week. Tidewater broke out again. It broke out a few months, kind of traded sideways there for a moment, broke out again. I'm now up 61% on it, seemingly not having a sufficient pullback. It's funny. It's funny how these things work. So I bought my first share of this at $40, and then it ran to $50. You know, as time goes by, people forget things, but it ran to $50, and I think it kind of fell back to 40, and then ran to 50, and then dropped back to the low 40s again, and I bought. And I remember buying it, the second share, at $43. And I was like, oh my gosh, it's above my initial cost basis, and man, this thing might fall, blah, blah, blah. And it still might. There's still more time left for that to happen. So, but up to this point, here I am up 61%. It's trading at $67. And it's just funny because when you should buy, you don't want to buy because of your emotions. And that was the right decision. And this year's actually gone pretty well for me. I'm out doing my benchmark, and that's all that matters at the end of the day. And that's the funny thing too, is my mandate with myself in Cup of Coffee Capital is to outperform the S&P 500. Now that doesn't mean radically outperform it. That'd be nice, but it doesn't mean that. It merely means to outperform it, which means if I think the S&P is going to fall, say, negative 20% this year, if I'm down 19, then I did my job. And if the S&P is up 20% and I'm up 21%, then I did my job. And this is relevant because people think that they need to take and expose themselves to as much risk as possible to generate as high of returns as possible, but that leads to a lot of volatility and perhaps even short-term underperformance. And then people struggle to stomach that, and then they dump at lows and so on and so forth. So that reminds me, because last month I told myself my goal is to merely not underperform. But that's the same way of looking at it. To say to not outperform is to also say not to underperform. So when in bull markets, I say I need to outperform. In bear markets, I say I need to underperform, because being down 19 when the market's down 20 is underperforming in a sense. That's just how I frame it in my mind. Even though it's outperformance, so to speak, but I'm underperforming the benchmark's further underperformance, and whatever. That's just how I think about it. And so last month I told myself that, and I barely eked out a gain for last month. I think up 0.42%. The market was down 1.25%, something like that. So I barely did it. and I would actually say I might have been negative on the month if it wasn't for this very last week in which I deployed capital, which I didn't even do on Monday. I think I started doing it. I'm getting nervous, and I'm nervous both ways. I'm just a above average person of neuroticism, trait neuroticism. So I guess this is all to say I don't know what's going to happen. Which is, no one ever knows what's going to happen, but I lack confidence in any direction. And I've felt that way all year long, and I've touched on the past about how other people, much smarter people than me, Druckenmillers and Buffetts, say that these are the most uncertain times that they've seen in decades, and they just don't know what to do. Like the obvious trade would buy treasuries, but buying I can't remember that speech that Druckenmiller gave a couple months ago about buying treasuries. And he's like, well, it's not so obvious. You think that would be the trade, but maybe not. And so I'm glad I'm not the only one confused, not to align myself with their superior intellect and discipline and equanimity and perspicaciousness. So you also notice in this that I didn't do the China trade. I made a post last week about the China trade. I didn't do it. I was hoping for a pop and drop. There was no drop. Monday morning it opens up higher and then fills the gap and then finishes the day. There was no drop. There was a slight drop, but there was no drop, so I didn't get in, and then it kind of gapped up. I don't know, FXI? I was looking at either doing half FXI and half KWeb. I was thinking about buying BABA or Pinduoduo or JD, but I was just going to do a basket approach, FXI, KWeb, KWEB, and I think FXI was up 3% for the week. So, but then I got to thinking about the China trade because I was kind of upset I missed that because it didn't drop. And then I thought to myself, I don't see China stocks going up if S&P stocks don't go up. And if S&P stocks go up, then I would think home builder stocks will probably go up because there's quite a good correlation there. And that's what led me, as you'll notice, to have purchased Builders First Source, BLDR, ticker symbol. And so I did. And the problem with that is the thing's up, 190% in the last year, and they're probably, they are earning above normalized margins. So if they suffer margin compression, then the stock could really come under attack, because you can see that on a price to earnings basis, it's still allegedly trading pretty cheap, even for a cyclical company. But then you start looking at price to sales metrics and this and that. And if interest rates go higher, then mortgages go higher, and that's going to put pressure. So there's a conflict between micro and macro that I can't settle. So what I've done is this week I bought more Valaris and I bought more Transocean. They hit my buy points. Tidewater came really close to hitting a buy point, but barely missed it, and then ran really hard. So how lovely that was, I say facetiously. But I added more shares of Transocean, and I added another share of Valaris. Okay, so that's things I added that's already been in my portfolio. Then I added to my portfolio Builder's First Source, and I added St. Joe, JOE, ticker symbol, which is a master plan community builder of properties in the Walton, Gulf, and Bay counties of the panhandle of the Gulf of Florida. And I really want to put a presentation on that thing, but I swear that video is going to be 2 hours long. And this is the stock I was talking about a couple weeks ago, about how I'm frustrated with myself because the one way I feel like I failed this year was not buying Joe. Well, at any point in time in life. And then they broke out on phenomenal report, Q2, ran up 20%. I should have put a chart on here. So now the question is there a gap reversal? Is it, what is it called? An island gap reversal? Kind of trades around and then breaks down and clears the gap. And you know what? I don't care. Like, some of it in part is emotional because I'm revenge trading, trying to compensate for my failure of not buying the damn thing all year long because I always thought it would go lower. Don't know why. Greed, ignorance, I don't know, but I've been wanting to buy it, and so I'm going to buy it. And right now you could say it's fairly valued in some sense. I mean, even though it's trading at 20 to 30% of net asset value, and then I guess you're paying a high multiple on what there's three segments: land sales, commercial, and then I can't think of the word. Hotels and golf courses, and I'm really drawing a blank here, so I apologize for that. But the point is those would be recurring revenues, the amenities, the commercial properties, the rents, the so on and so forth. And you're paying a whole high multiple for that. But anyway, what I want to say here about Joe is that I've never seen such a high degree of incompetence and people missing the point in comment sections on articles written about St. Joe. And I've also noticed something that kind of was an epiphany moment about a month ago. There's certain companies I follow that I never buy. Elf Beauty Brands is one of them. And it's funny what happens. You read the article, like this is the gist of it. Someone writes an article saying it's a good company, it has a promising future, it's going to grow a lot, but right now it's fairly valued. And then it goes up 20%. Monster Energy Brands is another one, which you might see me purchase. Even though I don't think I'm going to get 5,000, what is it? It's gone up 5,000% since, 10 years or something like that. I don't think it's going to go up another 5,000%. So don't get it twisted. But I think it'll have above market performance. Anyway, the story goes, it's a good company, it's going to grow a lot, good management, but it's fairly valued. And then the stock goes up 20%. And then someone writes an article that says, it's a good company, good management, promising future, growing TAM for the industry planning on growing at low single digits for the next decade, but fairly valued. And on it goes. Every 20 or 30% the stock goes up. And so that's what happened with St. Joe. Now you could say a few years back, when it ran really hard during the 2021, that maybe it was overvalued at the time. You could say it right now. But you know what? Like I'm just sick of it. So I'm just buying. I'm buying it. I don't plan on selling it. If it wants to close the gap, I'd be more than happy for it to close the gap. I actually want it to close the gap. I don't even care. Look, I don't expect where I've bought it here for it to be a positive impact on my portfolio for the coming quarters, which means it's going to weigh down on my portfolio. Maybe it runs. I hope it doesn't because I'd actually like to get a sizable position on it. So we'll see. Builders First Source, another company, like I said, it's gone up 190%. It's funny, you look at a chart, you go to Google, you type in Google, BLDR, stock, bring it up, bring up the chart, 1 year, 5 year, year to date, whatever. It's funny because it's just gone up, not in a straight line, but good enough. And that's the funny thing about linear charts. That's the funny thing about arithmetic versus geometric. That's the funny thing about linear versus log. Because if you look at a lot of things, like you go from the bottom or the past year and it looks like a hockey stick. But then if you go back farther in time, you'll actually see 300, 400% moves that don't look nearly as drastic as the recent move, which is 190%. So just looking at a chart can really fool you on that. Now, of course, it is a good tool. I don't know about Builders First Source. If TLT breaks down, i.e. long-dated treasuries break out, I have a stop loss currently on Builders First Source. Because my cost basis is $139, which is to say 8%, 9% of my portfolio in one share of one stock. And it was kind of a proxy play on the SPY, and the SPY was a proxy play on the China trade that I missed out on. Plus, I've been wanting to own Builders First Source. That's why I bought Louisiana Pacific. But sometimes you actually buy the quality company that historically has performed well. And so I did. That's kind of my S&P proxy, if you will, to give me exposure to the market if the market goes up. Because I'm not really bearish on the chart. It's funny, I'm not bearish on the chart of the S&P, but I am bearish the chart on the Treasury. And it's funny because I think if the Treasuries, the yields break out, that the S&P could go down. But then back to this 5 to 10% pullback belief. Was that 4.78 or whatever it was pullback? Was that the 5%? Or is September going to fall a good deal? I don't know. So this is what I'm doing. Hopefully I explained this well enough. I still have on my core positions. Essentially, I'm holding on to everything. YPF is now went up from being up, mid-single digits in profit to pulling back. It's going to do what it's going to do. Everything else are pretty much holds. So if the market does pull back, I'll either add to those positions or hold those positions. And I would say that Builders First Source is the only one that I might cut my losses on if the market pulls back. That's where I'm at. It's game time. My beliefs of the August-September pullback, here we are. Built the cash, see what happens. I suspect my decisions will make or break the year, erase my gains, or add to my gains. Of course, you could say that any day of the week, so it's kind of just platitude, but when you go from 35% cash to, what am I at, 7% cash? So I go from 35% cash to 7% cash. I've told you all before, I'm the type of person who will go from 50% cash to 0% cash in a day or 5. It doesn't happen often, but it's not beyond me. I'm the person who'll go from fully invested to 50% cash too. So I don't mind that. If something spooks me in the market, I don't mind getting rid of my lower conviction plays per se. Now, so far this year, you have not seen me do that. I've put on some trades here and there, clipped a few percent here and there, lost a few percent here and there on trades. But other than that, I have my core portfolio. I position size accordingly to my conviction, and that's just that. So this is actually the first radical move you could say I've made this year. And yeah, so we'll see how things play out, and hope you all have a good Labor Day weekend. Take care of yourself, recoup, and be able to get back to the screens fresh on Tuesday. Catch up on some things, spend time with your family, do whatever you do. And thank you for watching, and until next time.